Diving into the stock market can seem intimidating at first glance. The sheer volume of information can be overwhelming. It's a whirlwind of numbers, charts, and jargon that can make even the smartest person feel lost. The constant fluctuations and market trends can be daunting, but don't let that scare you away. With the right approach, you can navigate these waters confidently. At its core, the stock market is simply a platform where buyers and sellers come together to trade pieces of companies called stocks. It's a marketplace of opportunities. Investing in the stock market is like unlocking a door to a world of possibilities. Each stock represents a potential for growth and success. It's a chance to grow your wealth over time and participate in the success of innovative companies. Your investments can help drive progress and innovation. Imagine owning a tiny piece of a company you believe in, like a tech giant, revolutionizing the way we communicate, or a coffee chain brewing up smiles across the globe. Your support can make a difference. The beauty of the stock market lies in its accessibility. It's open to everyone, regardless of background or experience. You don't need to be a Wall Street mogul to get started. Everyday people can invest and see their money grow. With a little knowledge and guidance, anyone can dip their toes into this exciting world and potentially reap the rewards. Education is key to making informed decisions. So, are you ready to embark on this journey? The path to financial empowerment starts here. Let's demystify the stock market together and empower you to make informed investment decisions. Together we can turn opportunities into achievements. Now that you understand the potential of the stock market, let's break down how it actually works. Think of the stock market as a giant auction house, but instead of paintings and antiques, you're trading shares of companies. These shares represent ownership in the company. There are physical exchanges like the New York Stock Exchange. Picture a bustling trading floor with people shouting orders. Then there are electronic exchanges like the NASDAQ, where trades happen digitally at lightning speed. When you buy a stock, you're buying a small piece of ownership in that company. The price of a stock fluctuates throughout the day based on supply and demand. If more people want to buy a stock than sell it, the price goes up. If more people want to sell, the price goes down. You'll need a brokerage account to start buying and selling stocks. Think of a brokerage account like your passport to the stock market. It allows you to place orders and manage your investments. Not all stocks are created equal. Each type of stock has its own unique features and benefits. Just like there are different types of cars, each designed for specific needs and preferences, there are different types of stocks, each with its own set of characteristics and potential for growth. Understanding these differences is key to making informed investment decisions. Common stock is the most prevalent type. It represents ownership in a company and entitles the shareholder to a portion of the company's profits. When people talk about stocks, they're usually referring to common stock. This type of stock is widely traded and offers the potential for capital appreciation. Owning common stock gives you voting rights in the company and a claim on its assets and earnings. This means you can have a say in important company decisions. Preferred stock, on the other hand, typically doesn't come with voting rights but offers a fixed dividend payment. This makes it a more stable investment option. Think of it as a hybrid between a stock and a bond. It combines elements of both, providing a balance of risk and reward. Then there are growth stocks, which belong to companies that are expanding rapidly and reinvesting their profits back into the business. These stocks have the potential for significant capital gains. These companies are focused on innovation and expansion. They often operate in dynamic industries like technology and healthcare. Dividend stocks are issued by established companies that share a portion of their profits with shareholders through regular dividend payments. This can be an attractive option for income-focused investors. These stocks can provide a steady stream of income, making them a popular choice for retirees and conservative investors. Understanding the different types of stocks is crucial for building a well-rounded portfolio that aligns with your investment goals and risk tolerance. By diversifying your investments, you can manage risk and maximize potential returns. Section 4. Fundamental versus technical analysis. Two sides of the same coin. Now, how do you decide which stocks to buy? That's where stock analysis comes in. There are two main approaches: fundamental analysis and technical analysis. Fundamental analysis is like looking under the hood of a car before buying it. You're examining the company's financial statements, evaluating its management team, and assessing its competitive landscape to determine its intrinsic value. Technical analysis, on the other hand, is like studying the car's mileage and accident history. It focuses on charting historical stock prices and trading volumes to identify patterns and trends that can suggest future price movements. Both fundamental and technical analysis have their pros and cons, and many investors use a combination of both approaches. Fundamental analysis provides a solid understanding of the company's underlying business, while technical analysis can help identify entry and exit points for trades. The key is to find an approach that you're comfortable with and that aligns with your investment style. Section 5. Long-term investing versus short-term trading. Finding your strategy. Once you have a grasp of different stock types and analysis methods, it's time to determine your investment strategy. This is a crucial step in your investment journey, as it will guide your decisions and actions in the market. Are you in it for the long haul, or are you looking for quick gains? Your choice will depend on your financial goals, risk tolerance, and the amount of time you can dedicate to managing your investments. Long-term investing involves holding on to stocks for years, even decades, with the goal of benefiting from the company's long-term growth. This strategy is often favored by those who believe in the potential of a company and are willing to wait for their investment to mature. It's like planting a seed and watching it grow into a mighty tree over time. The growth may be slow, but the rewards can be substantial if you have the patience to wait. Short-term trading, on the other hand, involves buying and selling stocks within a shorter time frame, from days to weeks to months, to capitalize on short-term price fluctuations. This strategy requires a keen eye on the market and the ability to make quick decisions. Think of it as catching waves in the ocean. You need to be quick and decisive to ride the waves of profit. The market can be unpredictable, and timing is everything. Both strategies have their own merits and risks. It's important to understand these before committing to one. Long-term investing offers the potential for compounded growth and requires patience and discipline. The power of compounding can significantly increase your returns over time. While short-term trading demands constant attention and carries a higher risk, the potential for quick profits is there, but so is the potential for quick losses. The key is to choose a strategy that aligns with your financial goals, risk tolerance, and time commitment. Whether you choose long-term investing or short-term trading, make sure it fits your personal situation and investment objectives. Section 6. Building a diversified portfolio. Don't put all your eggs in one basket. Imagine putting all your money into a single stock only to see it plummet in value. That's why diversification is crucial. It's the age-old adage of not putting all your eggs in one basket. Diversification involves spreading your investments across different asset classes, industries, and geographies. This helps mitigate risk by ensuring that if one investment performs poorly, others can cushion the blow. Think of your portfolio like a well-balanced meal. You wouldn't want to eat only one type of food, would you? Similarly, your portfolio should include a mix of different investments to provide you with a balanced diet of risk and reward. Start by investing in companies across different industries, such as technology, healthcare, and consumer goods. Consider adding international exposure to your portfolio to tap into growth opportunities in different parts of the world. Remember, diversification is your best friend when it comes to mitigating risk and building a resilient portfolio.